Taxation, specifically to handle foreign tax credit and Equalisation Levy. We heartily welcome today's speakers. Welcome Mr. Venkatramanan and Bharathi. Welcome to the speaker. Please raise to the photo sound.
Sutteshu jagrati Yaesha sutteshu jagrati Kamam 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 sho Usho nirvimana nirvimana Tadeva shuklam brahma
Thank you all. Just a brief introduction about the speakers. She will Bharathi Krishnaprasad is a chartered accountant and is part of Venkatramanan and She has been a corporate banker with a wide experience in managing corporate banking. She focuses on direct tax and foreign exchange laws at this point of time. She advises clients on a broad range of issues relating to domestic and international taxation. She also handles complaints and litigation up to the stage of tribunal. Her qualification doesn't stop here. She is a company secretary as well as a cost and involves accountant. Besides that, completed CFA all 3 levels as offered by the ICFA Institute. Thank you for being here. And the next speaker is Mr. Venkatramanan, who is an associate partner in Venkatramanan and Chennai. He is a chartered accountant with more than 5 years of experience in advising clients on exchange control regulations and focuses on transaction-based advisory, litigation strategies, and assistance during investigations. That's a very key investigations, right? Further, he regularly represents clients before the tax authorities, enforcement director, which is a key specialization, AAR and tribunals, and a regular author of articles in taxation levies and a speaker in ICAI. So he is here again to share his experience and a speaker in IFA as well. Welcome. Over to you. And sir, to request your support in giving memento to the speakers at the start of this session. A small token of appreciation from the Institute. Thank you, sir.
My name is Pastor Lewis. 46971.
Oh, she's familiar with you.
You work together.
Okay, thank you, sir. Sir, go for it, guys. Sir, one more, two. Thank you, sir.
A very good evening to all of you. Today's session, the focus area is on foreign tax credit and equalization levy. Equalization levy we will be touching upon it towards the end. Predominantly, the session will focus on foreign tax credit. We will be giving you a brief overview, just introducing the concept, then we will be reading together certain clauses from few treaties which are relevant for our discussion, and then we will be discussing certain crucial judicial precedents, and then we intend to take forward the session in the form of case studies, which we would wish that it is as interactive as possible so that we can learn together. So that is the idea. So with this, now why is there a need for something called a foreign tax credit? Now we all know that we operate in a scenario where business models have evolved tremendously, and we are no longer confined to the brick and mortar mode of doing business. Globally, things have evolved. The interaction with international markets are intense. Therefore, for anyone in a particular tax jurisdiction, it is very common for that person, be it an individual or a company, to be getting income from some other jurisdiction. Now, because he is getting income from some other jurisdiction, and because by laws of that jurisdiction, and rightfully also, he would be using economic resources of that other nation, the other nation may also levy tax on certain income. That income will also be taxable in the state or in the jurisdiction where he or she is a tax resident. Therefore, we have a scenario where a particular income gets taxed in country A because it originates in country A. Country A, we call it as a source state, and it also gets taxed in another country, let us say country B, because country B is where this person is a tax resident. This is not a healthy economic practice for the same income to be suffering two taxes in two different places. That is a fundamental concept. Another form of double taxation can also arise, which we all know. Common example is dividends. Company pays tax on the profits. Some portion of the profits are distributed as dividends, and dividends are also taxed in the hands of the investors. This is also a form of double taxation. Now, this double taxation has to be addressed, and that is one of the reasons why the agreements are entered into between different jurisdictions, which are called the double taxation avoidance agreements. What are the aspects that are dealt with in this agreement is double taxation. Of course, there is a lot more. As we speak today, the things which are sought to be addressed through double taxation avoidance agreements are much more than granting of avoiding double taxation. Now, how can a relief from double taxation be granted? There are two kinds of. There are two ways by which this relief can be granted. One we call an exemption method, very simple, straightforward, without any headers attached. Simple exemption method. You pay tax in the source country, resident country grants you exemption for that income. A variation of this exemption method is something similar to how we aggregate agricultural income for rate purposes. It is exempt, but for me to find out what is the appropriate correct rate of tax, especially in a progressive taxation system where the tax rate is not a single number like 30%, it ranges from 5% to 30%, it will be included for the purpose of determining the rate of tax, and then appropriate credit will be granted. So in effect, the income is exempt. The other method, the second method, is what we call the credit method or NTC. Here what happens is, here also there can be variations, predominantly two variations. One is, you pay X rupees or X amount of tax in the source country, you get X amount of tax as credit in the resident country. Another variation is, you pay X amount of tax in the source country, but credit you will not get for the entire X. You will get that much of credit which is attributable to how much tax incidence is actually suffered in the resident country with respect to the income which is earned from outside here. So, granting full credit without having any conditions on quantification. Second is not granting full credit, rather stating that credit will be given, but it will be restricted to how much tax you actually suffer in the residence country. Now, in the Income Tax Act, the credit mechanism flows through two sections. Section 90, which basically grants power to the central government to enter into tax treaties. And one of the objects of tax treaties is to avoid double taxation. And all the tax treaties invariably contain a provision on how to eliminate double taxation. Most of the treaties grant what we have just discussed, which is the credit method. So this applies wherever we have entered into tax treaties. Where there are no tax treaties, then it is not a case that a person will not get credit. Person will still get tax credit, and that is governed by section 91. So 91 applies where there are no bilateral tax treaties between India and the other jurisdiction. 90 applies where there are bilateral tax treaties. Before we proceed further, it is important for us to look at some of the tax treaties on how the clause regarding to FTC is worded. Why is it important? Because while most of the tax treaties have a similar wording, there are some variations in few of them, and it is important for us to understand that variation, appreciate its nuance, so that we can see if we can leverage on how the language has been couched in each of these treaties. Ultimately, we are all aimed at getting credit for taxes we have paid, but what is the quantum? How do we compute? How do I maximize how much credit I can get, and which is authorized by the law also. The first treaty that we will be looking at is the India-Australia treaty. I will read the language slowly with emphasis at right places. So our request is read along with us silently and focus on the points, places where we are emphasizing, because this becomes important for the subsequent discussion that we are going to have today. Now, India-Australia DDA, and a similar language is also there, for instance, in India-Canada. What is given as credit is the amount of Australian tax paid under the laws of Australia in accordance with the provisions of this agreement, whether directly or by deduction by a resident in India in respect of income from sources within Australia which has been subjected to tax, both in India and Australia, shall be allowed as credit against the Indian tax payable. So the point which we are emphasizing here is subjected to tax. What is meant by subjected to tax? We will discuss further. And the Indian tax payable in respect of such income, but in an amount not exceeding that proportion of Indian tax which such income bears to the entire income chargeable to Indian tax. So what is important is there is a requirement that the income must be subjected to tax both in Australia and India. What is meant by subjected to tax? How do we determine as to how much is the income which is subjected to tax? Is it the gross level or is it net level? If it is net level, how do you compute what is the net amount? There are different issues that arise on account of this. We will deliberate on them. And this Australia DTA is not a case where the entire credit is given to you. The credit will not exceed that proportion of Indian tax which such income. What is such income? Income which is subjected to tax in both jurisdictions, bears to the entire income which is chargeable to tax. So credit is proportionate. There are some issues here also. We will be discussing that. Credit is proportionate to the income which is subjected to tax in both jurisdictions as opposed to the total income that you are offering to tax in India. Next DTA that we in India and Malaysia. Now here we will specifically look at this clause 3. Now because clause 3 deals with the concept of tax sparing. We will be dealing with it, but to briefly tell what tax sparing is. For promoting for economic reasons and to promote investment, it is possible that one country will grant some exemptions. If one country grants, let us say source country grants these exemptions, then you are not paying tax in source country. Therefore, you cannot claim credit here in India. But some treaties have this special clause where they say that where an exemption has been granted for economic and to promote investments for those strategic reasons, then credit will still be granted. How will it be granted? You will find out how much tax otherwise you would have paid. Had you not been granted this exemption in Malaysia, how much tax you would have paid in Malaysia? For that tax would be granted credit in India. So only if such a clause is present in the treaty will you be able to take benefit of it. If such clause is not present, then tax sparing credit cannot be taken. India, Malaysia is one of the treaties. India, Oman also has a similar provision. So for just completion, let us just read it. The term tax paid in Malaysia shall be deemed to include tax which under the laws of Malaysia and in accordance with the agreement is payable on any income derived from sources in Malaysia had the income not been taxed at a reduced rate or exempted from Malaysian tax in accordance with the provisions of this agreement and the special incentives under the Malaysian laws for promotion of economic development of Malaysian government. So this is a typical example of a clause which grants credit notwithstanding the fact that there could be some exemptions that are there in the society. This is India-US BTA, one treaty which all of us would have seen. But the language here is different from what we read in India-Australia. So let us just read it. Where a resident of India derives income which, in accordance with the provisions of this convention, may be taxed in the United States, India shall allow as deduction from tax on the income of that resident an amount equal to the income tax paid on the United States, whether directly by way of deduction. Here, the expression subjected to tax is not there. That is very important. They don't say that income must be subjected to tax. That phrase is not here. This deduction shall, however, not exceed that part of income tax which is attributable to income which may be taxed in the United States. So here also there is a concept of not granting the full credit but only proportionate to the income which is offered to tax in India and on which you have paid tax in US. But the crucial part is the expression subjected to tax is not figuring in the India-US. Correct. Here again, when they talk about the proportionate part, it says that income tax which is attributable to income which may be taxed in USA. Income tax which is attributable to income which may be taxed in USA. They don't compare it, they don't rather map it to what you are offering to tax in India. I will just, for a moment, if you see the India-Australia Treaty, it says that just a second. In respect of such income, but in an amount not exceeding that proportion of Indian tax which adds to the entire income which is chargeable to tax. Whereas here the language uses which is attributable to income which may be taxed in USA. So we will revisit this, but what we have to know is both treaties only stipulate or rather only grant a proportionate credit. But the language used in both these treaties are different in as much as the manner as to how you calculate the proportion. Whether we can say that we can take advantage from one treaty vis-a-vis other. And when the India-Australia uses the expression subjected to tax, what is meant by subjected to tax? This is a very different treaty. India and Namibia. Here, if you see, the tax credit is given in entirety, where resident of India derives income, etc., etc., etc. Then India shall allow as reduction from tax on the income of that resident an amount equal to tax on income or capital gains paid in Namibia, whether directly or by way of reduction. It is not proportionate. Only requirement is you pay tax in Namibia, you pay credit. This is the first scenario where we discuss on how credit will be granted. Whatever tax you pay, same you get as credit. India Namibia treaty is an example of that. This is India-France treaty. This requires that the income is included for rate purposes. This contains a clause which we just discussed a while ago, where you include the income but you aggregate it for rate purposes. We look at para 2, where the resident of India derives income which, in accordance with the provisions of this convention, shall be taxable only in France. India may include this income in the tax base, but shall allow as a deduction from the income tax that part of income tax which is attributable to the income derived from France. We all know that in some treaties, the source is delimited, rather the taxing rights are delimited. Some treaties specifically say that this income shall be taxed only in this state. That means that the other state cannot tax. Some treaties use the expression may be taxed. So their tax, the resident state also taxes it but grants credit. In India-France treaty, it says that if there is an income for which the taxing rights are entirely vested with France, yes, you cannot tax it, but you will include that income for rate purposes, and whatever tax you arrive at, you will again calculate an effective tax rate on that and then reduce whatever tax is attributable to the income on which France has levied tax. So you will include the income just for rate purposes. Now this is India-Mauritius PTA. Here what we have to see is this. So we looked at the example of dividends, where dividends are taxable in the hands of the shareholders. The company also pays tax on the dividends. Now, definitely, some portion of the income, two people are paying tax. Company is also paying, the shareholder is also paying. Unless and otherwise, there is a provision for granting credit in respect of taxes paid by the other person also. We cannot take benefit of that. We can take benefit of only taxes which is paid by the taxpayer. India-Mauritius Treaty has a clause which permits credit to be taken in respect of taxes paid by the other person also. So I will just read out this clause. In the case of dividend paid by a company which is a resident of Mauritius to a company which is a resident of India and which owns at least 10% of shares of the company paying dividend, credit shall take into account, in addition to any Mauritius tax for which credit may be allowed under the provisions of the umbrella, the Mauritius tax payable by the company in respect of profits out of which the dividend is paid. So, with this background, we will look at some landmark judgments, post which we will go and discuss some case studies that we have exclusively prepared for this seminar.
So, the first judgment is of the decision in the case of Wipro Limited by the Karnataka High Court. So, to give a background about this case, so here is a case where an assessee, Wipro, whom we all know it's the IT sector, has branches abroad in which they have foreign sourced incomes. And here, the two countries with which we are concerned with in this judgment is US and Canada. Wipro, since they were exporting certain services to foreign countries, and then that export transaction was subject to tax in both US and Canada as well as India. In India, you have this Section 10A, which are export-related incentives, wherein any any person who is engaged in the business of software exports, is granted a 10-year tax holiday in respect of the incomes earned by them. So what has happened here is, quasi export transaction, Wipro had paid certain taxes in Canada and in US. But quasi very same transaction, no tax was paid by Wipro in essence because of the exemption contained in section 10A. Because section 10 exemption takes the entire profits from the habit of total income computation. So effectively they didn't pay any tax in India, but they paid taxes in Canada and US. They claimed the credit of whatever taxes they paid in Canada and US and filed the return of income. It was disputed because primary question is, for you to have a double tax incidence, your income has been taxed only once. So where is the question of claiming credit? To appreciate this judgment a bit in detail, so what had happened is, section 90 of the Income Tax Act, when it was first introduced, etc., it said central government by notification, entered into a treaty with any other territory, specified territory or a country outside India for two purposes. One, for granting relief in respect of income on which tax is paid both in that country and in India, or for avoidance of double taxation. So the scope of section 90 as it was originally introduced was, government is given the power to notify any tax treaties, and the purpose of those treaties is to give relief in respect of income on which you have paid tax both in the source country as well as in India, or for avoiding the double taxation of income. In 2004, you have probably mentioned it as 2024. In 2004, when the section 90 was recast, what they had done is, they had expanded the scope. They said, government may notify any treaties for the purpose of, one, granting relief in respect of income on which tax was paid both outside India and India. Two, for avoidance of double taxation, that was stating. Three, for granting relief in respect of income tax chargeable outside the territory of India and income tax chargeable in India for the purpose of economic and other benefits between the treaty partners. So the scope of the DTAAs are expanded. What is the meaning of this particular clause? The first thing first, the High Court said, there are three besides this, there are other purposes for which you can enter treaty: for exchange of information, for ensuring there is no non-taxation both in India as well as outside India, for preventing intentional treaty abuse, etc. Those things are also there, which we are not concerned at present. So the court said these purposes can be bucketed into three aspects. Regularly, if a treaty has to grant, how do you understand? A double taxation relief can be granted in three ways. One, you pay tax on a particular income in the source country, you pay tax on a particular income in the residence country, so the income is doubly taxed. Resident country will give a relief for it. This is what is covered by the first thing, where income, granting relief in respect of income, in respect of which tax has been paid outside India and in India. So, to grant such kind of relief, the underlying precondition is income should have been subjected to tax in both the countries. Second, for avoidance of double taxation, how this can be done? While enacting a particular clause, they say that this income shall be taxed only in source state, this income shall be taxed only in the resident state, or they will say it can be taxed either in the source state, but while granting the relief in Article 23 for eliminating double taxation, they will say the resident country will exempt that income. So, for avoiding double taxation, a clause of this, any kind of provision of this nature is covered within the treaty. Then what about the third clause, where granting relief in respect of income tax chargeable under this act, income tax chargeable outside India for economic and investment related purposes. What kind of provisions will get covered here? These are provisions where you don't pay tax in India or some other country because of some exemption or for some tax incentive. But still, for those incomes, if there are some additional benefits granted, like what we saw in India, Malaysia, tax sparing, those are cases where effectively you don't have a double taxation. The income is taxed only once because of the way the law is on the domestic country. But still, treaties go one step further and grant some relief, saying we want to develop the investment in the treaty partner countries, so we are extending this benefit. So, when the section 90 was recast and it was amended to mean treaties can also be entered or notified for the purpose of granting relief in respect of income tax chargeable under the act and in India for economic and other purposes, treaties can also be notified for that purpose. Because of that, the governments had power while negotiating tax treaties to include benefits in the nature of tax sparing, which you find in treaties like Malaysia and Oman. Now they discuss this first. And then say, since unlike pre-2004 era where treaties could be entered or negotiated only for the limited purpose of relieving the double taxation and nothing more, post-2004, treaties can also serve an additional purpose of promoting investment and economic growth. In India, Section 10A, which grants exemption to export transactions, tax holiday for export-related incomes, is more like a provision which is aimed at promoting investment. Now, keeping this in mind, read the India-US DTAA. It says, where a resident of India, which is Wipro, derives income which, in accordance with the provisions of this convention, may be taxed in United States. Yes, it is taxed. India shall allow as a deduction from the tax on the income of that resident an amount equal to income tax paid in United States, whether directly or by deduction. Let's go to the next para bit later. Stopping here. What is the requirement of the treaty for granting double tax relief? First thing, the person claiming the relief should be a resident. Checkbox ticked. Second, the income which we are talking about should be taxed in United States by virtue of the treaty. It is taxed. Third, relief will be given for the amount of tax paid in United States. Tax has been paid in United States, whatever tax you pay is granted relief here. All the three conditions are fulfilled. Where is the question of or a requirement that tax should also be paid in India for you to get this relief? Plain reading of this sentence does not provide so. Why do you bar it? Revenue didn't have anything for it. Revenue said, you don't stop with this. And the reason why the court also kept this to observe this is because post 2004 era, the treaties can also serve the third purpose of not just relieving double taxation but also promote economic growth. This clause is an example of one such example where it is intending to promote economic growth. Even though you don't pay tax in India, claim credit of the foreign tax paid in US. So they start with that and then make this observation. Revenue said, go to the next clause, next paragraph, immediate sentence. It says, such deduction shall not, however, exceed that part of income tax which is attributable to the income which may be taxed in United States. Revenue said, impliedly this clause says, there is a for the income to also have been subject to tax in India, to whatever portion, assuming the tax rate in US was 20%, tax rate in India was 10%, the credit shall be restricted to 10%. In the present fact, since the tax rate in India is 0, credit should be 0. Court said this clause is not intended to serve that purpose. Court gave an example where this clause will apply. In India, the financial fiscal year or the assessment year is, for determining tax purposes, is 1st April to 31st March. Or previous year, the computation for computation purposes, we take the previous year, which is 1st April to 31st March. In US, for computing the tax, the period which you are concerned with is 1st Jan to 31st December. So now, say you have earned an income in US during the period from 1st Jan to 31st December. Okay. Now, let's take a period for 1st Jan 2023 to 31st December 2023. You earn some 10 lakhs income in US. You are concerned with filing the return of income for financial year 23-24 in India. Okay. In financial year 23-24, that entire income is not earned in the financial year. Only a proportionate of that is earned. This 10 lakhs, you prorate it, let's for sake of simplicity say 12 lakhs. Prorate it over 12 months, 1 lakh a month. So in April to March, you have 9 months of the US calendar year. So 9 lakhs is only the income attributable which is earned during the financial year for computing the tax in India. Remaining 3 lakhs is for the previous financial year. For 22-23, when you are filing the return of income, that 3 lakhs will be considered by you. So here, what is being talked about is that deduction shall not exceed that part of income tax which is attributable to the income which may be taxed in the United States. They said, while filing the return of income for the respective financial year, you cannot take the entire 12 lakhs as the income which may be taxed, because in that financial year for filing the return of income in India, say in 23-24 only 9 lakhs is taxed in the United States, in 22-23 only 3 lakhs is taxed in the United States. Consider the tax act proportionate to that and then claim relief. In 23-24 you cannot claim the entire credit for 12 lakhs. Similarly in 22-23 you cannot claim the entire credit for 12 lakhs. So the court specifically gave this interpretation keeping in mind for this particular sentence. And it is important to note this restriction or this proportionate thing which we are talking about, this clause is there in many tax treaties which India entered into. Say Germany, Japan, name, I will give you some 5 or 6 treaties in which this clause is there. Court said this will not apply to a situation where income tax should have been paid in India. This will apply only in these kinds of cases where an income is spread over 2 different financial years. You will have to restrict your credit to the income attributable to that financial year and negative the claim of the revenue. Now, when we initially said about the India-Australia treaty, we also said the same is how is there the India-Canada treaty, because in that case you also had a double tax income in Canada. For Canada, the court said, read the clause again. The amount of, for sake of simplicity, let's assume it's Australia itself, or you can read it as Canada. For the amount of Canadian tax paid under the laws of Canada, and in accordance with the provisions of this agreement, by a person resident in India in respect of income from sources within Canada, that is there, which has been subject to tax both in India and Canada, yes, no doubt, shall be allowed as a credit against the Indian tax payable in respect of such income, but in an amount not exceeding that portion of Indian tax with such income taxed to the total income. So here the qualification is not just tax, it is Indian tax. So the precondition here is you should have paid some amount as Indian tax, income tax. Then you can claim a relief against that income tax. When you have paid zero tax in India, no relief can be granted here. In US, there is no mention of the phrase Indian tax. It just says which is attributable to the, shall not exceed that part of income tax which is attributable to the income which may be taxed in the United States. The phrase used is not Indian tax. So the court said the logic given for US won't apply in Canada. So with respect to incomes where tax has been deducted or paid in Canada, and that income is enjoying some tax or exemption in India, unless the treaty specifies, you cannot claim that benefit. Here the treaty is very crystal clear. Treaty says Indian tax should have been paid for you to claim relief. Since you have not paid any Indian tax, in this treaty the government chose not to grant that investment benefit or that economic growth benefit. So you can't claim the relief of taxes paid in Canada. There is a third dimension in this case, which is in countries like US and Canada, apart from the tax levied by the central government, like how here we have the central parliament creating the legislation, there also you have federal system where federal government will pass one legislation for the entire country and you have state specific laws. There, unlike India, in US and Canada, you have state specific income taxes. So Wipro, besides being subject to the federal income tax, was also subject to state taxes in Canada, in US and Canada. They wanted to claim relief for those taxes as well. They claimed it under Section 91. The revenue said, under 91, if you want to claim any relief, the first thing you will have to cross is with that country you should not have any treaty. Only then you can go on for claiming relief under 91. In Canada and US, you already have a bilateral agreement, and the bilateral agreement does not cover within its scope the taxes levied by the individual states or municipalities, so you cannot be granted credit. But if you look at Section 91 of the Income Tax Act, apologies, we forgot to put that in the slide. I'll just read Section 91. Says countries with which no agreement exists is the marginal note. If any person who is a resident of India in any previous year proves that in respect of his income which accrued or arose during that year outside India, he has paid in any country with which there is no agreement under Section 90 for the relief or avoidance of double taxation, income tax by deduction or otherwise under the law in force in that country, he shall be entitled to deduction from the Indian income tax payable by him on a particular sum calculated on a proportionate basis. So the thing which you have to be emphasized is there should be a person resident in India and he should be able to prove that he has earned an income from a source outside India in a particular territory or country, and with that country, India does not have a double taxation avoidance agreement for relieving the income tax charged in respect of that income. It does not say India does not have a double taxation avoidance agreement with that country and stop. The double taxation avoidance agreement with that country should not be there for the purpose of relieving the double taxation for the income tax in respect of that income. And if you look at the explanation, income tax is defined to mean any excess profit tax or business profit tax charged on the profits by the government of any part of that country or local authority in that country. So 91 is not a simple case where just because you don't have an agreement, just because it's not a simple case where you have paid some income tax in a particular country, and with that country you don't have an agreement, then go to 91. No, it doesn't operate that way. You have paid income tax in a particular country outside India, and qua that income tax, India does not have a specific agreement with that country. And income tax is defined to be not just the tax imposed by any part, the federal government, any part of the government, including municipality. The court said, qua the state taxes, which is levied in USA, you don't have a binding bilateral agreement. So section 91 will apply. So claim credit under 91. Though you have a bilateral agreement with US, for the purpose of claim of the taxes levied by the federal government, in 91, you can claim relief from the double taxation levied by the states in US. So the income tax levied by the states in US, because the revenue tried interpreting this to mean, here you have paid income tax in US, with US you already have a bilateral agreement, so the 91 threshold is not crossed. Court said for meeting the 91 threshold, there should not be a double taxation avoidance with the country in respect of the income tax for which you are trying to claim a relief. In this case you have that with US, you don't have a DTAA to claim relief for the state taxes. So claim relief under 91. For both Canada and US, they said claim relief under 91, the state taxes. So, three things. Post 2004, the treaties have been expanded, the scope of the treaties or the purpose or objective of the treaties have expanded. Treaties can provide for a scenario for granting some benefit, and that benefit need not be aimed at relieving double taxation alone. It can also grant some kind of tax benefit for the purpose of investment and economic growth. Two, if in the treaties they specifically only if they say that tax should have also been paid in India and then only you will be eligible for credit, only in that scenarios you will have to see that you have paid tax in India or not. Otherwise, directly whatever is the credit you can pay and claim it as relief. Third, just because you have a treaty with a particular country, that doesn't mean that, and that treaty does not cover any other income tax levied in that country, that doesn't mean that your double taxation relief is stopped there. You are kind of not covered by that relief. Under 91, you can still continue to claim the relief in respect of the income taxes levied in that country, though not covered under the existing bilateral treaties, under the rule prescribed or the law prescribed under the section 91. So it's a very interesting judgment. We will just also, at this point in time, I would also like to point out that following Wipro, there have been many tribunal judgments which have held, especially which contain the phraseology similar to that of India University TAA. There are many tribunal judgments which have said even if the income is exempt in India, foreign tax credit is allowable. There are judgments on the other side also without considering Wipro. The Wipro judgment is presently under appeal before Supreme Court. The Supreme Court has decided to hear the matter. They have admitted the special leave petition. So we will have to wait and watch as to how this proposition pans out on a future date. The only concern for me with regard to an observation in this judgment is on the scope of treaties, whatever the court observed that even though if you don't pay tax in India, you can still claim a relief under the treaty because treaty's objective is also expanded to promote economic growth. That is fine. This interpretation on how 91 is to be interpreted, even though your bilateral agreement does not cover the state taxes, that is fine. The only reservation I have is, when I showed you the India-US DTAA, this is the exact phraseology employed under the OECD and the UN Model Convention. OECD and UN Model Convention read the second clause. See, had the second sentence not been there, I am completely with Wipro saying that yes, whatever you say is correct. The whole purpose of second clause, as explained by the OECD and UN in their commentary to the Model Convention, is that The second clause is only for the limited purpose of restricting the amount of credit which you can claim. If you have not paid, if you have paid a very less, if you have suffered a very lesser tax incidence in the resident country, the credit should be restricted to that extent. Meaning thereby, to give an example, if the tax paid in source country is at the rate of 20%, if the tax paid in resident country is at the rate of 15%, your credit should be restricted to 15%. That is the objective of the second clause, and they give an example for that also. Second clause, wherever they say income tax, they read it as if income tax levied or subjected to in the resident state. In this case, like Australia DTAA, they read it as Indian income tax. But Wipro, Karnataka High Court in Wipro did not read it that way. One more thing which I want to point out is the commentary to OECD Model Convention or the UN Model Convention was not placed before the Honorable Court in the course of the said judgment. So, to this extent, we personally feel there is a possibility that the decision might be overturned in Supreme Court, but we'll have to still wait and watch because the court has given a different perspective to it, because when the specific court has said, I go by the plain language of the treaty. In Australia and Canada, they specifically say Indian tax payable, Indian tax paid. Here they have specifically employed the words income tax. What am I to infer? I am giving a meaning and I can contemplate a situation which is covered here. What is there? Then why should the relief not be granted? So it's a very, a tricky argument and a very nuanced argument. Would be great if the assessees, taxpayers win it before the Supreme Court, but this is because the whole purpose is tax planning in other treaties have been specifically said so. You have what we showed in Malaysia and Oman. There is a specific clause to give a benefit of tax planning. So they could have very well made that in US. They didn't do. To give another perspective to the arguments to this issue. So we'll have to just wait and watch.
Just one more point. The revenue in this case also contended that you are talking about 2004 amendment where the scope of entering into treaty has been expanded to also cover scenarios where the income is chargeable to tax, but you will be providing relief to promote economic and investments. But this has come into effect only from 2004. The India-USA DTAA has been entered much before. When India-USA DTAA was entered, the scope of entering into treaties for the government was only in respect of granting relief of taxation wherever tax was paid for the contracting states. Therefore, you cannot read 2004 amendment to say that the clause in the India-USA DTAA is covering that also. You have to read it contextually. Therefore, if you read it contextually, it will only cover scenarios where tax is paid, because at that time the power of entering into treaties was restricted to only that scenario. The court said that no, this cannot be seen that way. The 2004 amendment, probably it is giving sanctity to what is already there in the treaty. Without that also this treaty could have been entered. Without that also this could have been part of the treaty. We should also see how this argument is appreciated at the higher court, that's the Supreme Court. Because if that argument, the nuanced point of that argument is, you read however you want to interpret the India-USA DTAA, but you see what was the power vested with the government at that point in time. Would they have entered into a treaty which permitted granting relief even in the case where tax is not paid in India? The revenues contention is that is not the case. You cannot read it like that. We will also have to see how this argument is also dealt with by the Apex Court.
Sure, that was another interesting argument that the court said once the treaty is executed and notified under 91, under 90 subsection 2, that will apply if the provisions are beneficial, and they stopped with them. They never went into the aspect of could the government have entered into such treaties. That was not tested. So these are some of the, I would say, the areas which we have to look out for when the matter travels to Supreme Court. Comes up for hearing before Supreme Court. This is another interesting case of Vijay Electricals. So, to put it simply, I have earned an interest of say 100 rupees. Say the tax rate in Brazil is 10%. 10 rupees is the tax which I should suffer in Brazil. Brazilian laws, according to the Brazilian laws, that tax will be paid as and when by way of TDS apparently. That was not too much discussed in the judgment. So what had happened is, on that 100 the tax to be paid is 10 rupees. The subsidiary company to whom I lent the loan paid me in year 1 80 rupees. He deducted tax of 8 and paid me 92 rupees. In year 3, the subsidiary company paid me the remaining 20 rupees, deducted tax of 2 rupees and paid me 18 rupees. So the tax of that 10 rupees was paid in 2 phases in Brazil, year 1 and year 3. 10 in year 1, 8 in year 1 and 2 in year 3. So total 10 was paid. And this was also proved before the court. In year 1, when I filed the return of income in India, as a resident, what I did, I showed the entire income as 100 and paid the entire credit of 10. The revenue disputed it. See, what you have paid in Brazil is only 8. You will be restricted the credit only to the extent of 8. Beyond that, you will not be given any credit. The court said, observe 3 things. 1, the entire income was offered to tax in year 1. You don't dispute the fact that the total tax liability for this income is 10 and the fact that this 10 rupees has been paid also to the government. Albeit in a later year, 2 rupees was paid. Third, the treaty was similar to what was there in Australia. It will say that whatever is the tax paid in Australia, you can claim as credit. The revenue halved at that point. What is paid in year 1 is 8, you will be given the credit only for 8. The tribunal judgment, the tribunal made an interesting observation. When a particular term is not defined in the treaty, you will take recourse to the domestic law. That's there in every tax treaty. Paid is defined in section 43 to mean also incurred, and you have judgments on that point. Paid means does not mean only actual payment. Even if an expenditure is incurred, it is deemed to have been paid. You have judgments on that point. They say that here tax paid means tax incurred. Here you have incurred a liability of 10 rupees in year 1 itself. So there is no harm in granting you the credit for the entire 10 rupees. Again, a departure from what is the general understanding of double taxation relief. But to an extent, this proposition seems to be fine because it's not a case where I offer only 80 as income and try to claim the credit of 10. I offer the entire thing as income on accrual basis. I wanted to claim the entire thing as credit. And I have also proved that I paid tax in the later part of the year. So this observation is kind of serving the purpose for double taxation relief. Is to be granted. So the next judgment is by Ahmedabad Tribunal, the case of Allied Core Technologies Private Limited. So here what would have happened is the assessee would have rendered some fee for technical services to customers abroad. In the year of entering into that services, they have incurred some expenses and they would have earned some income, etc. Everything done in year 1, everything is done and dusted. So say 100 rupees is the revenue to be earned. Say 35 rupees or 40 rupees is the expenditure. 40 is claimed in year 1, 100 rupees out of that 100, because of this retention money clauses, etc. The customer paid only 85 rupees is in year 1. So what had happened is now we are in year 3, and year 3 assume is year 3, the dispute is in year 3. In year 3, 15 rupees was paid to this assessee. In year 3, unfortunately, this assessee was under the book profit method, taxation under book profit. So as per tax, there was amount was lower, so they had to pay tax as per book profit. Now the question which the assessee raised was 15 rupees which the customer paid. That 15 rupees is the doubly taxed income because that is suffering tax in Singapore and that is suffering tax in India. So whatever is the tax which I have paid in Singapore, I should be granted credit. Doubly tax income by the, meaning he said doubly tax income by virtue of the, because there are some expenditure, I want to say, I pay tax in Singapore, I am going to pay tax in India, so entire credit should be granted, because here the tax deduction is 10 and 15%, India as a company, even under book profit you would have paid 18.5%, so entire credit they wanted to pay. The court said, you cannot be given full tax credit. How? The whole purpose of the double taxation avoidance agreement and this article 23 or 24 in the various treaties which deal with relief of double taxation is to relieve you from an income on which you have paid tax in two jurisdictions. In Singapore or in whatever country which we are, Indonesia in the present case, the taxation is happening on gross basis. You render FTS of, you earn an FTS of 100, in a normal example, 100 rupees is what is the income which is subject to tax in Singapore. Say 10% is the tax, you pay 10 rupees of tax in Singapore. But when the same 100 rupees, if you are offering to tax in India, you don't pay tax at the rate of 30% on this 100. On this 100, you compute the deductions. Say 45 rupees, 55 rupees for the sake of simplicity. So on the net, 45 rupees is what you pay tax. So your doubly taxed income is only 45 rupees and not 100. Because what is chargeable to tax is only 45 rupees. Though you have paid tax on 100, the remaining 55 is an income where you have paid tax only once, that is in the foreign country. On that 55 you never paid tax in India. So your credit will be restricted to the tax attributable to 45. In Singapore, if the tax rate is 10% and India, if the tax rate is 30%, 10% of 45 you will get the entire credit. That's how you will see. It is because in India the taxability is always on net basis, subject to certain exceptions. Here, interestingly, what has happened is here it's a case of a retention money. What we are talking about is 15 rupees. In year 3, when the assessee is receiving this amount and offering it as income, there could be by no stretch of imagination any expense which is attributable to this income. So, this 15 rupees itself is your profit in year 3. Since you have paid under book profits, your total book profit is 54,13,000. This 15 rupees or 15 lakhs for the sake of simplicity is directly forming part of this 54 lakhs. Compare that 15 lakhs and divide it by 54 lakhs. Whatever is your percentage, that is the percentage. 15 lakhs by 54 lakhs is the percentage of the tax on which you can claim as credit. 100% of the profit you pay tax at the rate of 18.5%. If for 15 rupees, how much tax you would have paid? What is the percentage of tax? It will be 15% of 18.5%. That will be the tax incidence. Compare the tax incidence with the one offered in Singapore. Whichever is lower, take the credit. And they also say, how do you apportion or determine the effective tax rate? Ratio. You cannot just like that apply the turnover basis, etc. All these are dependent on facts and circumstances of each and every case. In this case, you have to apply the proportionate based on the total profit earned because there is no expenditure attributable to that income. In some other case, there could be some expenses, in which case you would have to reasonably allocate the expenses, identify the doubly tax profit, and then identify the tax incidence attributable to that profit. That has to be determined on a case-to-case basis, and accordingly tax relief has to be computed. Before going into the another very interesting judgment, which will be explained by Bharathi, I will just discuss one more judgment. So here is a case where again, what would have happened is, assessing filing return of income, they claim some tax credit, etc. based on this proportionate working out, whatever said and done. In book profit, you have two figures, two revenues. One revenue stream is your doubly taxed income. Meaning revenue stream means gross receipts. 100 rupees is your doubly taxed income, doubly taxed receipt, and you have expenses also. And some 20 rupees is your other income like dividends, interest, etc. To determine the effective tax rate, what the assessing officer did is, so assuming 120 is your total receipts, 80 is your expenses, your book profit is 40. What the revenue did was, instead of comparing this 100 by the total book profit, like your total turnover 100 by, instead of computing the book profit as 80 per, your 40 rupees is your book profit, 40 by 120 they had to do, and then arrive at the tax incidence, 40 by 120 into 18.5%. This is what they should have done for arrive at the effective tax rate. Instead, what they did was, this other income is never related to this double taxed income. So, other income is finding place in total turnover of 20 rupees. I will remove that from 20 rupees. 40 also I will remove that other income. I will do 20 by 100 into 18.5%. Court said, when you are going by a formula based approach to identify the proper effective tax rate, what you should do is, the effective total receipts are 120. Compare the profits qua that 120. For 120 rupees of total receipts, you want a profit of 40 rupees. Then for a total receipt of 100, what would be your profit? Based on that, identify the effective tax rate. You cannot just like that remove the other income saying it was entire other income is a profit and then I will exclude it from the computation. That you cannot do. So all these are very fact specific, depending on your facts and circumstances. For you to identify the effective tax rate, you will have to do it. So this is a very interesting judgment on the foreign tax credit, which we personally felt after withdrawal. I allow Bharathi to explain the various perspectives to this.
This is a decision of the Mumbai Tribunal in Bank of India. So let us just imagine these facts. So I am Bank of India. I have royalty income of 1 lakh from US. I have dividend income of another 2 lakhs, let us say from Australia. I am carrying on some business in India. In that business, I have a loss of 10 lakhs. So now when I compute my total income, royalty, dividend, and this loss gets knocked off, my total income is negative. That is the scenario of loss, 7 lakhs is negative. I claim credit. So for this 1 lakh and 2 lakhs income which I get from outside India, taxes were deducted, I claim credit for those taxes in India. The department agitates that, saying that, boss, you have not paid any tax in India, you have filed a loss return. How can you claim credit of these taxes? This matter goes up to the tribunal, they deny the entire credit. Before the tribunal, I of course rely on Wipro. I say that how you should read it contextually and why I should be eligible for this credit. And I make some interesting arguments. The SSC says, in this case, generally what do we say? When we say we have loss, we will say that will reduce our income, and only after knocking off losses, if at all some income is left, we will pay tax on that. So loss is looked at as a benefit for tax saving perspective. When you have loss, you pay lesser taxes. The SSC here said, see, I have loss of 10 lakhs. I have this 3 lakhs income. You are saying this income, I didn't pay any tax in India. That is not the scenario. You see from a holistic perspective what this income has done. This income has gone and reduced my loss. This 3 lakhs income has gone and reduced my 10 lakhs of loss. And what has happened as a result of that? Only 7 lakhs of loss I am able to carry forward to next year. It is not a case where this is not suffered tax in India. It has suffered tax in India. You cannot say it has not suffered. It has reduced my loss and I am entitled only for the reduced amount of loss. The SSC also goes and substantially proves that in the next year I am reducing only the 7 lakhs of loss. Now, let us assume in our example, next year I have 15 lakhs income. 15 lakhs income. 7 lakhs loss is carried forward. 8 lakhs will be net income, lost total income. On that I will pay 30% tax. Suppose my loss eligibility was 10 lakhs. I didn't have this fall in income. What would have happened? I would have paid tax only on 5 lakhs because this 10 lakhs would have been knocked off. Therefore, by paying tax on 8 lakhs, what is happening? In year 1 there is no outflow. But in year 2, I pay tax on 5 lakhs plus 3 lakhs. That 3 lakhs is nothing but my income which I have earned. So it is not a case that I have not paid tax. Point 1, my loss is getting reduced. That is akin to it being subject to tax in India. Even if you are not agreeing to that, you look at the subsequent year. This reduced loss only I am carrying it forward. And inherently I am paying tax on this income. May not be near 1, but I am paying tax on this income. The right has said, see, you are doing mainly what you are doing here is, by claiming this credit, you have claimed refund. What refund you have claimed? You have claimed refund of tax which you, not refund of tax which you paid here. You have claimed refund of tax which you paid in some other country. That is contrary to the principle of double taxation avoidance agreements and contrary to the principle of international taxation in general. Second, you are saying that subsequently you reduce these losses, lesser losses you are carrying forward, you are reducing the 7 lakhs, all that. But all these are subsequent stories. The tax relief which you have to be given, that cannot be based on things which happen subsequently. That has to be based on what are the facts as on date. As on date, what is the scenario? Have you paid taxes in India? Answer is no. If you have not paid taxes in India, you cannot be getting the credit. In your case, you have made profits in the second year, therefore you have paid taxes in the second year. There could be some other scenario where continuously somebody is incurring losses and they don't pay any tax on it. So whatever has happened subsequently, that cannot be the basis for granting credit now, and therefore you will not be eligible for tax credit in a scenario where you have losses. But between us also, we had deliberated a lot on this point. And we have put in a case study also where we will be discussing some scenarios on how this judgment is there. We may agree if we choose to decide it, but right now we have this judgment. When we come to the case studies, we will be discussing little more detail on certain scenarios on how probably we can be in spirit of this judgment and yet see how we have to understand the concept of tax relief whenever losses are reported. Tax tariff we explained when we started. Just to reiterate, this is a peculiar scenario where there is no tax levied in the source state because of some concession or exemption that is granted, but a relief is given in the one decision in the context of Thailand. This presently, if you look at the India-Thailand treaty, this tax barring will not be there. But at that point in time, when this decision came, there was a tax barring clause. The SEC therefore claimed credit when no tax was actually paid. The court held that they recognized the presence of the tax barring clause in the treaty, and they held that this claim is embedded in the treaty itself. So it is not something that you are claiming outside law. Treaty is also law. This is embedded in the treaty itself, and therefore this credit should be available to you. Just a judicial step to whatever is contained in the treaty. Now, so far we have discussed the provision in the Income Tax Act, Section 90. We discussed Section 91. We discussed the provisions under multiple tax treaties, how the clauses are worded for claiming double taxation relief. There is also a rule which we have to understand. Effect from 2017, Rule 128 was inserted into the income tax rules, which governs on how credit has to be granted. Despite this rule being there, once you complete reading this rule, you will probably appreciate that even after this rule, none of us will still have clarity on how the FTC has to be computed. Lot of things will still be left open. But this rule, which is supposed to be helping us, but contains certain guidelines on how credit has to be computed. But nevertheless, the specifics of how the computation has to be made, what is doubly taxed income, how should an effective tax rate be computed, none of these are addressed in this rule. Okay, now what is tax credit? Now, any tax that you pay in accordance with the provisions of the treaty, wherever there is a treaty, and where there is no treaty, any tax that you pay in the foreign state according to the laws of that state. Now, what is important here is any tax that you pay in accordance with the treaty. That is very important. Why that is important? Is because there can be scenarios where the treaty gives you a beneficial rate. Treaty may say that, let us say royalties, however, the rate shall not exceed 10%. Or the treaty may say that this will not be taxed in this particular state. This will be taxed in some other state only. So there are different permutations and combinations. Suppose one country from where I am receiving income deducts tax at a higher rate, or deducts tax when that income is not taxable as per the treaty. There can be two scenarios. TD says restrict the rate to 10%, but in their local law it is 20%, they deduct 20%. For example, we have no. If there is no ban, if they don't give all these details, if there is no Aadhaar PAN link, higher rate. So some kind of scenario could be there in that country also, higher rate of tax. Or that income may not be taxable as per treaty, taxing rights would have been given to some other state, yet that other state could be deducting taxes. In those kind of scenarios, whether India should give credit, answer is no, because the credit will only be granted where the tax has been paid in accordance with the, or the tax has been paid or deducted in the other jurisdiction in accordance with the provisions of the treaty. So where 10% should be deducted but 20% is deducted. Just because they deduct 20%, I cannot be getting credit for the 20% here. I will be getting credit only to the extent of 10%. That is important. And against what can you claim this credit? Tax, surcharge and cess. And very obviously, you cannot claim this credit against any interest or penalty. That is very clear. Now, what should you keep in mind when claiming this credit is you should file a specific form, which is Form 67. This should be filed online, and this should be filed before the end of the assessment year, which is a recent amendment. Before that, the filing of the form was required to be made on or before the due date of filing the return of income. But while you can file the form before the end of the assessment year, your return should have been filed within the original due date or within the belated return. Okay, and notion in the other jurisdiction. India does not have a concept of carry backward of losses, but there could be some other jurisdictions where the losses could be carried. So in those situations also, you will have to file Form 67 when there is a scenario where because of that carry backward there arises a refund in that other jurisdiction. So with this, we will go to case studies one by one. So our request is that we will read out the case study. We would want responses on what you think should be the answer for these case studies, and likewise, like that we can go about with the discussion.
So the first case study is not about the mathematics involved in FTC, so we have skipped it to this end. So the scenario is, there is an Indian entity which has a branch office in US. The financial year of US, as I said, is calendar year. And in India, the fiscal year is the financial year, which is April to March. Though the income will accrue and become chargeable to tax in India, the effective rate of tax which is paid in the US is not determinable at the time of filing the return of income in India. So let's take an example. You are filing the return of income for assessment year 24-25. Your income computation is based on previous year 23-24. Now in previous year 23-24, you have April 23 to December 23 and Jan 24 to March 24. This April 23 and December 23 falls within the fiscal year of US, which is 1st Jan 23 to December 23. Assume you earn some income in US during that period. And the income, or let's take an example where you earn some income in US during Jan 24 to March 24. That forms part of the next fiscal of US, which is 1st Jan 24 to December 24. While the concerned party, while making the payment in US, might have deducted tax at source while giving you the payment. We usually presume, because most of the countries have this withholding requirement. But that need not be your final tax. And the final tax for you would be available only somewhere in 2025 Jan or Feb, when you file the tax returns in US. Say tax has been deducted for 10 rupees in US. On what basis, while filing the return of income for April 23 to March 24, which is assessment year 24-25, we will claim the tax credit? Because that tax is not the finalized tax. What will happen in that scenario? You have offered that income to tax, you have determined the tax liability, etc. Whatever it is you have determined. How will you determine the credit?
So you may know how much tax he has deducted. Most of the cases we will know if something is deducted. For example, if it is in US, there is a form 1042 capital S, which is the form which will evidence that this much tax is paid in respect of that particular person in the US. That form you will get in December only. Or rather, somewhere in February only you will get. Only at that time you will know what is the actual tax paid for the whole period. So Jan to March you may know how much was deducted. But that may not be the final tax which you have paid for that particular income for that particular period of Jan to March.
I think similar situations are over in section 155. Here there are no such problem in section 155, but there are several subsections section 155, which is taking into account the subsequent changes in the income on the previous levels. I don't deal with individualized cases, that's why I don't have exact idea. But is there any other problem in section 155 which is controlling?
So the amendment in 155 came in 2023 Finance Act. Till then, for TDS you already had an issue. Like if there is a revised TDS return or a late claim, because you would have offered the income, which return you will offer, can you offer it can you claim the credit in the year in which the tax was deducted? that complication was there. Amendment in 2023 put them to rest. Unfortunately, similar amendment is not there for this purposes.
So what do you suggest? So that I think we're going to get your answer on this.
Yeah. See, it's all about practicalities in so
How to go for 264?
But you can go if there is an order. There has to be a subject matter condition.
Yeah, but once you file the return, the regular only taking a particular amount as credit. Then you can go for 264 with the personal intimation process issued once you file the return. You can go for 264 against the intimation.
what if there is no intimation etc. issued and assume the tax credit which you have claimed is 10 rupees based on the deal, because naturally you will claim the credit based on the TDS which is deducted or the advance tax which is paid.
No, let us say it's a provisional amount.
Provisional amount. So when you file the return, say it comes to your notice that you could have claimed an additional credit of 2 rupees. Now, there is no intimation for you, there is no assessment which is taken. How will you claim this credit?
Oh, generally they pass an request for the issuance of intimation from CPC. It initially processes all returns.
But not in many cases intimation gets issued, no?
I think it can request for it.
Okay.
No, sir. Anybody who is this with me? I think they are supposed to issue the intimation.
Because we have seen cases where there is no intimation that has been issued. Cases have been directly taken up for assessment. See, in refund matters, they issue the intimation for you to process the refund. In tax liability matters, we have seen cases where intimation is not. See, usually it's a process they will have to issue, and there is a time limit for issuance of intimation as well. In cases where intimation is issued, I can still file a rectification application also.
Sure.
The concern in the rectification application would be that
It's not a mistake, it should be.
there should be a mistake which is apparent on the face of the record.
Right. Correct.
So you cannot.
That's why section 152 was introduced. And there are lots of changes which could not have been utilized at the time of filing of the return and at the time of issuance of the order. That's it.
Well, especially 155 was needed also in the context of a lot of real estate transactions, where or even other transactions where subsequently the TDS proceeding people deducted tax, but the person on whose name it was deducted could not be. Here, such a provision is not there. Therefore,
You will have to
two
include
options. One is, two options. One is, if you get the information before your revised return filing date is around which is December, then you file a revised return. You also revise your citizen. But if that passes that stage also, or if you don't have an order which you can, play around with 154 or 264, then the only other option is for you to go before the CPDT. Now the powers have been delegated to various officers. In fact, recently 2 days back there was a circular to delegate the powers depending on the quantum involved. So you go before that particular officer. Of course, the reason for you approaching them now is also justifiable. Most likely now. More often than not, it will be entertained. So you tell as to why you could not have made that credit detail, because you did not have that information. And you make that additional claim of credit along with request to revise your return on income. That is how it can be entertained.
Either law should prescribe a mechanism or you will have to find a way out practically as to what needs to be done.
So in a letter that I could say never pay the correct amount of taxes, so that at least would be sure that indicate.
Yeah.
In a letter.
Yeah.
In fact, sir, in one case, filing this combination before CPDT or the authorized officers for claim of refund is still okay, because that is the purpose of that circular also, when you want to claim refund or losses. There happened to be a scenario where an assessee did not know, he was not aware that there was some interest income. Basically, he thought only this income and he missed it. Subsequently, some interest income appeared on the 26th AS.
Yeah, that's 2.48 interest.
We are on the 26 AS. He could not file revised return of income. He paid the taxes and he went before the CPE so that tomorrow no further problem comes. Go to the application, say that I am not able to file revised return of income. I have paid taxes along with interest. Please permit me to revise my return also, so that if at all something has to be done with that revised return.
See, in some cases, when we have income, the source country, they direct the TDS, they give withholding tax certificates. Going by the rate of same tax, the entire withholding tax can be claimed in our tax payable here.
Which country, sir?
One now what they would be giving money. This is being raised in models. As a percentage of the thing, they direct TDS. Sometimes they give withholding certificate. So going with this DTT, what you are saying is only that the tax attributable to that income can be claimed. See, that is the case, that the withholding tax will not be equal to what the attributable
Because
tax.
they will be claiming certain deductions.
Correct. So it means effectively that whole withholding tax certificate, the entire amount can be claimed. That's what the interpretation is.
Depends on the treaty also. Entire amount, in general, the principle is only that much quantum of the tax which is withheld in the other state, which can be related to the income which is taxed in India, can be claimed. Suppose 1 lakh is the amount that you receive from one. 10% is the tax rate, or let's say 30% is the tax rate. 30,000 they would have withheld, they would have paid 70,000. Right? In India, against that 1 lakh, you have 60,000 extra. 40,000 is the net income. On that you pay 20% tax. You pay 8,000 tax here. At no given point in time, your credit can exceed 8,000. It is 8,000 or an amount which is less than 8,000 depending on the language. It can never exceed 8,000. WIPCO is there. The aspect is WIPCO is one, it was before Rule 128, that is one point. But again, Rule 128, even if it says something contrary, the treaty can be because of section 90 subsection 2. Because treaty will be.
Yes, you have to claim the entire withholding tax based on the certificate. So far, no queries have come from there.
If suppose the tax that you pay in that other country is 5%, or
It's 10%.
10%. It is 10% and you are paying a tax of 30% here. And most of the credit invariably will be entitled. But again,
But you have to compute and see, no?
you have to compute and see. The question is, what is the doubly taxed income? This is why we were highlighting what is meant by subjected to tax. In India, if you look at the definition of income, in section 2, the income definition will include profits and gains. It will not say gross receipts. So 10, you sell goods, you receive income. That gross is not your income. After subtracting all eligible expenses, what is computed as profits or gains from business or profession as per the Act, by claiming all eligible deductions, that is only quantified as income under the Income Tax Act. So, if 1 lakh is the income you have received from Oman, 60,000 is the income that you are offering to tax in India because you are eligible for deduction. The doubly taxed income will be 60,000 because the definition of income under the domestic law, income is defined to be profits and gains. Income is not the cost.
Unclaimed tax can be claimed as expenditure.
There are divergent views, sir. In fact, we are going to cover that. Under section 37, whether you can claim as an expenditure, they are divergent. You must be aware of section 48 clause 2. That will say that if there is any tax which is payable on any business or commission, that is not allowable as income. Tax definition is there in 2 clause 43. There are cases which say that you read tax definition, it will cover only taxes in India. If you pay income tax in India, obviously you cannot claim a deduction. But if you pay income tax in some other country, it is not hit by the reverse impose and 40 clause A clause 2. Therefore, you can claim the tax deduction. That is one line of decisions. The other line of decisions say that you look at the whole purpose. You have paid tax in some other jurisdiction for this income. Because you have paid tax in some other jurisdiction, somebody is trying to give you credit. So by giving the credit, you are already being benefited. Now, what are you trying to do? You are trying to claim that unclaimed portion as an expenditure, further reducing your Indian tax. That is not even the intent for which treaties have been negotiated and entered into. Therefore, this, and you cannot read tax definition from section 2. Section 2 definitions can only be used, in definition starting will say, unless the context requires otherwise. You should see whether the context requires the definition or not. Here the context does not permit you to adopt section 2 definition. You cannot adopt that definition. Contextually, you have to see any tax which you pay on income, be it in India or some other jurisdiction, it will assume the character of tax on profits which is being paid by you, and therefore it will be given by 48, you cannot take it. There is a Reliance Bombay High Court which is in favor, which will say that whatever we discussed just a while ago, that only taxes paid in India will be hit by the reverse of the disallowance portion. So you can claim. So there are divergent views in the court. Just how like cess was ultimately decided and then finally amendment was made for education cess. Similarly, either amendment will be made or Supreme Court will say something.
From the business perspective, we are losing people. They don't permit the referential pay. Okay. Actually, we are
see, if you claim in region of income, the problem of penalty is also there. Therefore, these kind of matters, you should lodge a claim and your assessment proceedings are paid.
So now we will come to the computation part. So there is a resident company which is incorporated in India. The following are the incomes that is earned by this company. 1 lakh of business income. Expenses is 25,000. Long-term capital gains of 90,000 from the sale of shares of a US-based company. And FTS is rendered. FTS is services rendered for a person who is resident in US. And you have other sources of income, domestic interest and dividend income of 15,000, and you have income from sale of virtual digital asset, which is taxed at virtually 15,000, which is taxed at a special rate of 30%. So now on this FTS, on this entire 1 lakh, tax has been withheld at 20%. Capital gains, 90,000 is the capital gains. On this 15% tax was deducted, so 13,500 tax was deducted by US. How will you, what is the proportion of foreign tax credit which you can claim in this example? So your total foreign tax credit is say is 20,000 plus 13,500, which is 33,500. Can you claim the entire foreign tax credit? If you want to claim the credit, how much credit is that you can claim? How should you claim?
After adding all the other sources, capital gains, you calculate the proportion tax which is applicable on the end. Or the special income must be essentially to tax. It has to be taxed on this. So
assuming your business income is taxed at 25% because of the taxation rate.
Let us go step by step. Let us answer the first question. What is the deferred tax?
75. With respect to our business income, it is 75. But FTS. When the capital gain comes to like forest, there is more reduction with respect to capital gain. So the 90,000 will be working tax. This other sources is in India or India, and PDA is in India. So that working tax is 75%.
Somebody has to know 75%. So now, how will you determine what is the FTC agency?
So the capital gain in India it is 12.5%.
So 3%.
Will you delineate each source of income and see, or will you aggregate the total tax paid, find out the effective tax rate, and then apply it?
This long-term capital gain and PDA is charged separately, so I will be separating and proposing.
Now, if you separately see what is the credit attributable to the capital gain which you can take. Let's say tax rate is 10% for sake of simplicity.
So 9,000 is taxes paid. You have 13,500 paid. If I take, I will be eligible for
So since your logic for treating it as separately is because it's a special rate of taxation. What will you do for the FTS?
It is taxed at 20%. For us it is 25, so the lower is 20, then that credit will be 20%. Sorry. Only 75,000 is the current tax. So tax on that is 25% or 75,000. I will get tax on, and I have to pay the aggregate tax and compare which taxes.
75,000 into 25% is your Indian tax.
Yes.
How will you come up with it?
If I have all, I will not be charged 25 on the total. Right? I have separate special tax rates.
If the income in our example is both at the normal tax rate is income from other sources.
Yeah, that's artificial will be charged at 25%. The balance we have a special. So I will at least do this business income and other sources, and I will get the tax amount. I will get the proportionate tax. What is the tax?
How you determine the proportionate taxes are defined as 50, 1 lakh 25, 25%. So 25 to 25% is 31,000 to 50.
For tax, which is how I will make the responsibility is 50,000.
Foreign tax credit is
Only on this is
correct.
Your foreign tax, which is paid on this is 20,000. So this entire 20,000.
No, I only tax equals to 70. Before I complete 75,000, 25% we get 18,000.
Now, why 28%?
Indian? Okay. tax rate is 20%. So 75,000 is 20%, that can be claimed as which is
15,000.
the row of tax 25,000.
This is not be. What will be your answer if this treaty part is we are not yours?
It's all the credit right. So what was tax rate paid? 20,000 plus 13,500 as 33,500. Only tax calculated.
What if this is Australia? That's why I said I'll give you the degree.
That is subject to the tax.
US, okay. US said proceed. This is the Australian treaty. How will you come to it? So we have 90,000 capital gains, 75,000 business income, 50,000 other sources, 50,000 ED. Okay, first for Australia also you will do income wise credit allocation or how will you do? Huh? Why? So total how will you in total now how will you determine this? So your total tax would be 75,000 plus 50,000, 125,000 into 25% is 31,250. 90,000 into 10% is 9,000, 39 to 40,250. And 15,000 into 30% is 4,500, which is for 44,750 will be your total tax in India. Total income is 75 plus 90, 135 plus 50, 185. How much is 250 plus 50, 230. 44,750 divided by 230,000. Your rate is 19.23%. Okay. In India, your tax average rate of tax is 19.45%. Now, how will you determine the credit?
So the last portion of that.
That's what you have done. 19.45%. How will you determine the credit? 19.45% we have allocated as the effective tax rate in India. How will we determine the credit?
On 75,000. 90.4, that is the credit.
On 90,000?
90,000, there's no, so in India, there's no tax there.
Why?
90,000.
30,500 is 11.
8%.
Even if we take that the company tax includes only the capital gains and for that, if you take the calculate the tax rate comes to 18.3 for the 1,50,000 plus, sorry, 1,50,000 for the tax market, 20,000, 20% and 15% tax rates for business.
So you
Yes, yeah.
So,
1,68,000.
the tax amount the person aggregate person comes from 22.5.
So your average tax rate even for yours.
Yeah.
Okay.
But we can't compare for the total income for this 19.45 includes all income, the other sources and also.
So here, 1,68,000, 19.54%. Service 33,500. You have to see.
Maintain 33,500.
Which is lawyer.
No, that's why I'm saying you will compare against 33,500 only.
Yeah.
Why?
That's total tax paid. It means the total credit is going to be.
But what is your W tax income? Your W tax income is not the entire 1 lakh, no?
75,000 is included.
So 75,000 plus 19,000, 1,65,000. And 32,500 is the total tax paid. Total tax.
So you are saying you will arrive at the effective tax even in.
Not effective tax. 1,68,000 at rate of 19.5%. Vis-a-vis 33,500.
Okay. No, the 33,500 is for
tax paid there.
tax paid there. On 1 lakh plus 90, 1,90,000.
No. See, here tax included is only 75,000 here in India. 75,000 plus 19,000, 1,68,000 is tax income included here. 1,68,000, 19.54% whatever it is. Vis-a-vis 33,500, which is lawyer has to take it as a credit.
1,65,000 into 19.45%. 32,092. That will be the credit.
That is 33,500.
Yeah, that is the 1,60,000 is the doubly tax income, first of all. What is the income that's doubly tax? First we arrive at that. That's 1,60,000 as the rate is set.
Tax on that, you have to rate about 19.5%.
Why do you know 19.45?
Yeah, that is the total income quotient. You have to record with the DT says no.
So that is for India you do. For finding out the tax incidence in India you do. For finding that foreign tax paid, why do you apportion that?
So foreign tax paid because effective rate for India for foreign credit to be taken, either you have to take 23,500.
What if you have paid tax of only say 20,000 in
US.
US?
You have to take 20,000.
No, that's why in the same you get to know the average rate of tax, get to know the doubly tax amount of income. Then the simple first thing is certain average rate of
So
tax.
now you are
Second thing is there.
okay. So for US, you did it income wise. What to say? You are
Not income is what
no. What I think is first scenario.
We split special rates in special rate incomes and then we arrived at the rate.
In the second scenario of Namibia, we said
We said full credit is
full rate available. Third rate of Australia, we said you see holistically.
But according to me, sir, you should not compare 19.48 into 1,68,000 with 33,500. Rather, you should compare this 19.48 into 1,68,000 with 28,500. Reason being that the doubly tax income, as far as this technical services is concerned, is 75,000. For that doubly tax income, the tax that you paid in USA is not 20% of 1 lakh but 20% of 75,000. This is 15,000 plus 13,500. So you should compare 28,500 with this 19.48 applied on 1,60,000.
The revenue rejected.
In that case, you will get 28,500.
I'll give it 28,500 rather than now I get the 30,000.
No, you can't do that, no, because
See, what is the revenue right now?
Revenue will
Okay, I will take this time. But so we should assess 30,000.
if you look at okay, so now we come to certain perspectives in this. If you look at the Rule 128 and you look at the tax treaties also, you look at the commentaries to tax treaties to the commentaries say the treaty has at the broad level specified how relief should be granted. The specifics, mechanics, etc., I leave it to the wisdom of the legislation. If you come to Rule 128, it specifically says you will have to calculate the foreign tax credit for each and every source separately, even if it relates to a single country. So here you will have to determine the FTC separately for business income, FTC separately for capital gains. As per Rule 128, you cannot cross it up. And similarly, assume you have these transactions in 3 different countries. Again, you will have to see for each and every source in each and every country separately. You cannot cross your entire foreign tax credits and work it. That is point number 1. I think there is a Bombay High Court judgment in the case of Burma Trading Company that also explicitly says you will have to do it for each and every source of income separately. Like what we do as a cumulative basis, that cannot be done. To that extent, I feel that this comparison on the gross, on the total for every income put together and the every Indian income tax paid, I think that is, I would say, it's fairly understandable. So we'll have to read it source wise. Now, coming to Australia, what you did was, since first you will take the fee for technical services. 1 lakh is the income which is tax paid there. So 20%, 20,000 is the tax paid. But what is taxed in India is only 75,000. So straight away 25,000 into 20%, which is 5,000. There is no relief for you. We are talking about the 15,000 now. Now in this 75,000, how will you determine the tax credit? Like what you pointed out. So you will have to compare the proportionate of that income to the total income, so 75,000 by the total income of 2,45,000 into whatever tax you pay, the effective tax rate, so you will have to compare. Similarly, what you did for capital gains, again 19.45%, you do it and you compare it. My only question is, why don't you want to do the very same approach or follow the very same approach for when it comes to US tax treaty? Just to go a bit further on the US tax treaty, US tax treaty also says, now we are keeping what has been said in Wipro aside for a moment. If you apply Wipro, then unlike Namibia, whatever is the entire tax paid in US, you can claim it as a credit. Because the second part of the deduction is not a restrictive condition. As long as Wipro is there, you can try to claim that argument and then say what when it comes to US, whatever tax I pay in US, I can claim it as a credit. So that is one school of thought. But again, if you ask me in my opinion, that tax should also be restricted to only 15,000 because that 25,000 is never a double tax income. So for it to claim relief for that is not possible. That is one thing. Now read it like any other OECD commentary, like how OECD commentary wants you to do. What they say, this deduction should not exceed the tax incidence on that income in India. That's what this this line says. For you to determine the tax incidence on this income in India, why do you have to say it's only 20%? Is that the only way of determining the tax incidence on this income in India? Can't they take the Australian method of determining the tax incidence? See, when it comes to this example, Australian method is kind of bit unfavorable to you because the tax incidence is still lower, so 19% is there. But generally I am asking, when it came to US, you said I will see, even comparison wise, I will see for each and every income. For business income, the tax rate is 20%, so 20 vis-a-vis, so 25%. So 25 vis-a-vis that 20 I am comparing, so 20 is lower, I will take that. You will do the computation like the way you did for Australia. Treaty also says the amount should be restricted to the tax incidence suffered in India for that income. For you to determine the tax incidence suffered in India,
Sorry, US. So India amount is deductible. India amount is deductible.
No, that's why you will have to read it. You read it.
Just the way the language.
That's what Wipro went. And that's why they said you don't need to pay tax in India. So you will have to keep that aside for a moment for you to understand the university. Because then if you apply Wipro study, the entire credit will be given to you. Now if you want to apply like what commentaries want to do, one way of doing it is 25% is the tax incidence. The other aspect is like how you did for Australia. Australia went one step further and then has given you a perspective as to how that should be computed. Compare the income chargeable to tax, the double tax income chargeable to tax with the total income, and in that ratio you restrict the credit. That is also one manner of determining your tax incidence. And your FTC provisions will only say in Rule 128, you claim the credit of foreign tax which is paid on, the credit on foreign tax will be lower of the tax paid in India on that income or the tax paid in India in the outside territory, whichever is lower. Unfortunately, FTC rules in India do not provide a manner of determining the tax liability for that income in India. When that be the case, it is not. What I am just trying to point out is to determine the tax incidence. That the one approach which you said initially is not the only way. The other aspect of comparing is also there. But logically speaking, the first approach which you said will give a more correct picture. That gives a very true picture for that income. So when the total income in your of 2,45,000, in that for that income you levy tax of 20%. To be more precise and perfect, 25% is the correct tax incidence on that income, because in the total income in Indian term, that's the correct way. But the way we are looking at for Australia, because the treaty is that way, Australia is kind of deviating from the normal route of determining the tax incidence. Again, the problem is he would want to claim or work out the credit in a way which is more beneficial to the assessee. The department would always come back and then point out which is not. What I am just saying is the treaty is very wide enough. Similarly, the rules are also very kind of open in the sense that for you to, there are room for interpretations is what we are seeing. Perspectives don't. How do you find out the reasonable method of, it's like apportioning the expenses, common expenses to different business verticals. You might have one approach which is suitable to you or which you find it reasonable. For the other person, the other approach will be reasonable. It all boils down to how do you justify, how are you able to convince that your approach is better. This is the next case study. It's just a further variation of the case study to the facts remain the same. The additional facts which we have is, we have a brought forward business loss of 40,000 under Chapter 60 reduction worth 25,000. Leave out the other additional fact, that's just another added complication to it.
You will just stick to brought forward loss and
Chapter 60.
Same.
Just going near the things. Now, how will the FTC be computed? Let's take US loan.
In the business income will be considered after the loss of 40,000. Reducing it 75 degradation.
40,000. Sorry. 40,000, 35,000.
First for me, is it we have to compare it individually or
See, again, I'm just what I'm saying is, I give you another perspective that you can come for you to find out the effective tax rate. But what you have to compare is the doubly taxed income. Tax incidence on the doubly taxed income. The first example, what is the tax incidence on 75,000? What is the tax in India? What is the tax incidence of 75,000 in US? One way of looking at it is 25% is the tax incidence in India and 20% in US. If seen that way, the entire rate in US will be available. If you say 19.48% is only the tax incidence, then 19.48% of 75,000 alone will be eligible for credit. Then 20% of 75,000 you will not be eligible for the credit. That gross level of cases proves might result in a negative situation. In some cases, might be positive in some situations. That depends on how your other special rates of taxation are. Okay. I just wanted to say it as a perspective too. In assuming that case you wanted to follow the Australian approach, 75,000 of 19% is what you would have been eligible for the credit, not 75,000 of 20%, which is 15,000. So again, beyond 5,000, there is another 1,000 rupees you would have lost that credit.
If you miss sometimes, you refer to a case and the losses to be carried forward for 3 lakhs or so that the bill will be paid. Wouldn't that case apply in this instance? I think in the withdrawal case.
There is Bank of Chicago.
That's all.
That there is one differentiation which we want to point out there.
So let us first emphasize here. This 40,000 business loss, ideally what will you do?
Reduce from the business income.
75,000 is what we
35 even end business income. And we have a chapter 6 reduction.
Targeting tax against 70,000. What is income targeting tax is 70,000.
even if you set off the loss.
75 or 35?
He said 75 or 35 is the question.
If 35 then not be foreign tax. But 30, 40 carry forward cannot be foreign tax.
Then what about the 25,000 of expense? How did you come up 75,000? It's because after deducting of 25,000 of expenditure incurred locally, it has no foreign component. But still,
At least here we are identifying this year, this assessment year, that is the last year assessment year. Carry forward, you know what is the proportion there.
no, assume that was completely from domestic sources.
Let us assume it is domestic source only. Then 40,000 brought forward loss. It is entirely
It's
domestic.
entirely domestic.
If you knock that off against business income, you can knock it off only against business income. That is
Yeah,
what
obviously.
So, is your doubly tax income 75 or 35? If I am the income tax authority, I will say that law permits you to reduce that loss from your foreign income.
Like expenditure.
Like it's like an expenditure only. When you subtract expenditure, you say doubly tax income is not 1,75,000. Here again, the law permits that loss to be set off against your foreign income. Therefore, doubly tax income is only 35,000. Will be my stand as an officer. That is one question. Second, this chapter 6A, 25,000.
Only impact on the effective tax.
Will it also have an impact on how much is your doubly tax income? Right?
Because we have other income.
See, we have 50,000 of other sources.
So, just because you have other income, does it mean that chapter 6A does not impact at all your doubly tax income?
You say
If I think the effective rate of tax it will impact.
So,
If we consider all, if we come all the income and calculate the effective tax, sure that 25,000 will have an impact. It will be
see,
reduced.
this chapter 6A is a general reduction. Not like your ATPA and all, which is against that income, or ATM, which is against that income, applicable to that income. There, if you say that chapter in 6A, I will allot it to that income, that will hold water and maybe that is right also. If the income tax, if we
I will say, as an income tax officer, map it in the ratio of your income from business vis-a-vis your total income and income from other.
That's what I said.
Because you have two components on eligible persons.
So your 78,000 minus 40, 35, plus other sources of 50, 85. So 30 by 85 into 20, 25,000.
And let's say that comes to 10,000 or something.
So company tax income will further reduce to 25,000. So effectively your credit will be restricted to your 25,000 into 25%, vis-a-vis 25,000 into 20%. Just one thing, is it necessary that you will have to set off this business loss against your business income? Huh? It can be set off only against business income.
But is it necessary that you should set it up?
That's what I'm saying. That can be set off only against business income. My question is a bit different. I'm asking, is it mandatory that if you have a business income in a particular year and you have a brought forward loss, you will have to set off the brought forward loss?
As an option.
No, what I'm saying is, if assuming today I have my question is, instead of setting off against the business income, can I choose to carry it forward and set it off in the next year? Against, if I have a business income.
I don't think that option is there for you.
Why?
I can't really say what the exact reason, but the Western law, it can't be carried forward indefinitely.
On the back leg, the matter press on
I'll put you a question in other words, in some other words. Can this keep set up of brought forward losses of this year? And
That's what my question is.
Yeah, I did just different.
That's what.
I don't think so. And I think someone who specifically says, it says that I think it lays down the order of the set off.
That's right. We wanted to read that particular provision.
It deals with the carry forward and all.
72 deals with. Yeah.
Memories as well. This 72 deals with the loss.
Yeah, 72 deals with brought forward losses. It says.
Business losses.
Business losses. It says where for any assessment year, the net result of computation under the head PGBP is a loss to the assessee, and such loss cannot be or is not wholly set off under against any income under any other head of income in accordance with the provisions of 71. So much of the loss as has not been set off, or and he has no other income under any other head, the whole loss subject to the provisions of this chapter be carried forward to the next assessment year, and it shall be set off against the profits and gains, if any, of any business or profession carried on by him and assessable for that assessable year. If loss cannot be wholly so set off, the amount of loss not so set off shall be carried forward to the following assessment year, and so on.
So, naturally, it goes without saying that you need to adjust the loss in the next assessment year.
So, you can't postpone the brought forward losses.
This is what happened in any assessment year. If you talk total income is less than the taxable rate, you not adjust it. You can declare for the next assessment year.
So, that is one way of looking. But for this provision, without this provision being enforced, would you have been able to set off the brought forward business losses? Or set off your last year losses against the next year? These provisions are more like a concession given to you by the law. You wish to either take that concession, you can choose not to take that concession.
You can't carry forward next year then.
Why?
See, if you wish to not take the consideration, you have to take the consideration this year. If you forgo the consideration this year, you can take it next year.
Should this share actually, I guess, should share, right?
Shall is always mandatory.
Should, right?
Shall is always. But in some cases, correct. Going by the language, the option is gone. Either you choose not to set off. If you choose not to set off, then you cannot carry forward. That is
mandatory to be set off. You don't have an option to say that I don't want to set it off. Keep it as. When share comes in, automatically that is how it should work.
not in all cases. Shall should be read as shall. There are adjustments to
See,
that.
if you forgo the losses, you do not carry forward, then you can't carry for extra surplus to live also.
You will have the loss repeated in case you don't choose to set off the brought forward loss this year. Provided there are non-good business losses. According to my understanding.
Sorry?
According to my understanding, either you claim the set off of the brought forward loss this year, or just allow it to be repeated.
That's
See, there are a lot of long-term losses we have to take this, we don't get loss. We don't get loss.
That's it. What the possibility which we are trying to explore is carry forward and set off is not.
It's not a relative process, it's an automatic process.
That is one thing. More than that, the context of this provision is more like a concession given to you by the law. You can choose to have this, you can choose not to have this.
Okay.
And that's what I'm saying. To complete it, in all these cases when the law says shall, it can be read as a discretion. You may choose to set off and you may choose to carry forward up to a maximum interest. No. What I'm saying is in the context in which these provisions are, you can try exploring the option of not setting off the losses. Yes, there will definitely be a difficulty in mitigation, etc., which you are anyways going to face. One option which you can try exploring because of the way these provisions are. These are not.
That will not stand, definitely. Logically, see, as per Income Tax Act, the law, tax liability is calculated on the basis of our income tax law. When a specific provision is deviated,
Notwithstanding the foreign income, even from domestic income, if there is a carry forward loss, and if this year assessment amount is less than total income, we can't carry forward the next year.
Sorry?
Suppose this year, the assessment year, total income is less than taxable limit, assuming you are individual, and you are doing business. Total income is less than taxable limit, and you are carrying forward loss of last year. I cannot carry the losses to next academic year assessment year without setting up this assessment year.
yes.
I think there is a controversy about depreciation. Somewhere in 2002, and the court said that it could be claimed at the choice of the SSC. Then the amendment was brought in to say that it's to be mandatorily claimed or is allowed to be lapsed.
In fact, I was about to point it out. It is contained in Explanation 5. In depreciation context, the law specifically says that it is hereby declared that the provisions of this subsection shall apply whether or not the SSC has claimed deduction with respect of depreciation in
No,
permitting
that amendment was brought in specifically to offset that Supreme Court decision or to nullify that particular decision. The Supreme Court decision
So, for example, you can't claim depreciation, you can carry forward next academic year and do it.
That you cannot do
Yeah, that's right.
because of this
Same for us also.
That you cannot do because of this amendment.
That's
So
what I'm
it's
saying.
you're extending that to the business person. Since it is here, you cannot do. Since it is not there, it can be.
Can you?
Can
That is
you?
the question. Because now that there is a question mark at what is the doubly tax income and there is a loss involved. The ICAI decision says if you have loss, you can't claim credit only. Meaning thereby that there is no income which is taxed in India. The doubly tax income is zero. Some income is getting taxed there, nothing is getting taxed here. So according to ICAI, doubly tax income is zero. We may deviate from that. We may have a difference in view, but at this point in time, as we speak, we have this ICAI decision. So there is definitely dispute on what is the doubly tax income. Is it 75,000 or is it only 45,000, 35,000 in our example. So when that is there, if we are otherwise sure that we will be able to exhaust this loss within the time frame of 8 years, can we take a position that no, I will not set off this loss today? depreciation. Can we take advantage by saying that such a express clause is not stipulated anywhere?
It's part of that accounting itself, depreciation. And management can decide. This is a thing with management.
Actually,
Sorry?
Depreciation, to charge depreciation or is a management decision there. So they can, not charge depreciation to people for that academic year, that accounting year, they can carry forward. Don't leave
But
as
for
it is.
income tax, you have to, that's what the
And it's because of the
explanation is, even if you don't claim, I will give you.
That is because of the supplement, otherwise.
Correct.
Whereas here, there's already a business loss is there, and you have to carry forward business loss, you have to accept for carry forward business loss for last year.
That's what I'm saying, sir. Even prior to the amendment also, depreciation commission said you will have to charge depreciation.
I don't want to charge it.
That's what I'm saying. Like, commission said you will have to.
Provision is giving this option for me.
Definitely, can we agree with you that to take the position that laws will not be, I will choose not to set off, probably will be much more litigated than what is the W tax thing.
See, even in 32, when it said foreign direction shall be allowed. In case of an assessee, prescribed percentage of depreciation block basis. Here also the word used is shall. But still, assessee is used that.
no. What they used to do is, they did not provide the requisite details to enable the computation of depreciation. That's how they skipped this particular mandatory problem. So, to nullify the accepted board decision, this particular expression I was brought.
That's what I'm saying.
First. Secondly, sometimes the word may shall be interpreted as shall, and sometimes the word shall may be interpreted as may. But that is not always possible, especially that so had where procedures are concerned, like filing of return, like filing of audit report in Form 10B. Only in respect of the procedural matters, there is some laxity shown by the courts.
So that also
But not where the substantive or competition provisions are concerned or qualification provisions are concerned. You just check.
I'm with you. Correct. I'm with your understanding because even in the case of procedural claims, in the context of Indian Supreme Court, they didn't file the claim for the DTA.
Because see, for filing a revised return,
No.
you have an omission from some
No. That was what I mentioned. They failed to file the audit report within the due date, which was a mandatory condition for him to claim that deductions after 6 years.
Report said that
That's a mandatory condition you should have
you
done.
will not let the eligible
Just giving you a perspective, you said for procedural you can take the argument. We usually take the argument in the context of procedural law. Even there, the Supreme Court is bit thing.
I think there must have been several issues which are noticing also noticed. Where they say that the audit report will form 10B in the filing time.
Correct. What I'm saying is, apart from the Supreme Court, there are tribunal judgments which are saying it's discretionary, and I'm also with you saying that these are computational provisions. So here, shall should be interpreted so strictly, and then you cannot have any kind of discretion with you. I am definitely with you on that point. What we are just trying to explore is, it's a new area put together on FTC, and deductions and benefit of carry forward and brought forward losses are all mercies or concession granted by you. Can you read in that context shall as may and then try taking an argument?
You say there is one possibility, but what about your take on this? No, we are covered our take, our views. You tell me your views.
Even our view, what I'm saying is, I would say a 60-40 situation where 60% it's in there against, it will go against the SSE. It's on the SSE side, it's going to be very risky and task for a very ridiculous position. What I'm saying is,
it's unfair.
that's why it will probably be much more litigative than deciding what is W tax. But as a food for thought, is this position also possible?
Taxation, even a normal assessment, what is the take on this?
Normal assessment, it won't be there, right? Because what would happen is, in essence, it would reduce my tax liability.
No, I thought that since I don't need tax this year, I don't adjust this was loss.
If you go by the exact problems, I think the client will have to lose on this.
Definitely there
That
is
would be rather unfair.
Definitely.
Apparently. Losing this principles of natural justice, but still, law is law.
And that's why you cannot expect it.
Yeah, that's true.
In fact, when we were discussing, our discussion started on how we feel Bank of India may not be right, and why according to us doubly tax income should be 75,000 and not 40,000. But of course we had different, we were arguing on for and against amongst ourselves. And then, is there any other way out? Is something possible? So as put forward, we wanted to see, because similar explanation file, like what is there, 32 is not there here.
To just give one more other example, you take 72. Assume it's got a brought forward test. You have, say, let's say here it is FTS. So assuming the doubly taxed income is the same 75,000, it's a dividend income. Okay, and you have a loss under the net business of say 40,000 under business. Without setting it off against the dividend income, can you directly carry forward that loss to the next assessment year?
Same question again and again.
There I will give you an interpretation. Your current year, same year set off is dealt with in 71. 71 says, where in respect of any assessment year, the net result of computation under any head of income other than capital gains, other business income, is a loss, and the assessee has no income under the head capital gains, he shall be subject to the provisions of this chapter, be entitled to have the amount of such loss set off against this income, if any accessible for the assessment year, there will be a rate. So there is an entitlement. So that entitlement is against business against dividend income, I could have set it off. Okay. Since it is an entitlement, I can choose not to do it also. Now come to 72, which seems to carry forward of the business loss. So assuming you did not set off, whether you can carry forward. Now 72 says, where for any assessment year, the net result of computation under the head PGBP is a loss, and such loss cannot be or is not wholly set off. If the word is not wholly set off is not there, money cannot be set off, then according to you, if there was a situation where you could have set off, you didn't do it, so that you cannot carry forward. But it doesn't stop there. It says cannot be set off or is not wholly set off against the income under any end of income in accordance with the provisions of 71. So much of the loss has not been so set off, or where he has no income under any other head. So when it comes to the current year loss, firstly for you to set it off against the other sources, there is an entitlement. You can choose to set off, not set off. With respect to carry forward also, you still have the option to carry forward because either it cannot be set off or it's not set off. In this case, I chose not to set it off. I could have carried forward. When for current year loss, going by the provisions, I could take that benefit of not setting off and then claim a higher FTC. When it comes to brought forward losses alone, going by the scheme of the Act, can't take that position. Is what we wanted to just plant a thought. Yes, we can always debate. We wouldn't want to advise their client saying that you take this position, but when it comes to litigation or somebody, or you don't take the claim in written, but at least an assessment if you want to take this as an option and fight the matter. Is this a possibility?
Suppose our FTC is denied and we make this as an alternative.
Alternative claim, because for current year loss, going by the provisions, it's not a mandate that if you don't set off, you cannot carry forward. Like that, the provision is not there.
Can I add a remark?
Yes.
Yeah. I think we got two sets of income tax law. One made by the Parliament, other made by the CPC. If you just see notice, the amendment which were brought into the computation of income for charitable trusts, those things were there 2 years back also in the CPC computation program. So, do you think that CPC would readily accept such sort of thing? No.
That's what I said. Don't make a claim in return. Wait for the assessment to come. Then try making an additional claim. So that it's more like a Assessee has got nothing to lose.
In fact, if you make additional claim before AO, he is not going to entertain. He will say Supreme Court, why you
No,
can
no.
make this.
It also Supreme Court said that recently.
So you will go before CPE.
That's also additional claim you make and then cite the matter. In which case, assessee is also not at a loss. Ultimately,
Unless you make a claim,
You can't do anything.
you can't try to.
Unless you file the return, income tax return, you claim that you can't go.
no, you have the warrant it as Supreme Court, which allows you to make a fresh claim before AO.
But the
Most of the business for itself.
AO should first enter for assessment
Yeah.
under section 103. But much before that, the CPE system would make the adjustment.
That's what I'm saying. In those, you invite an assessment order somehow.
Usually, sir, this FTC adjustment, okay, loss of CPC will be, definitely I agree with you. If you don't set out loss in your return of income, CPC is,
CPC will set up.
but FTC related,
You have to try the option C. The CPC is absolutely cannot utilize the option.
No, sir, because the moment you are planning to try, it's more like the client being having an exposure of penalty or some interest component. That's not right.
We should try, but the total income is less than tax
Just a
amount,
question here.
and with the setting up, we should carry forward the losses.
Whether the return of income will get accepted, that is the point that I was just
They don't do it like you
because it is almost automated, right? Entire thing is automated. You don't have an option to not set up carry forward kind of thing is not available, right? Who knows?
You have to play the option. For local
override the set off, there is an option which override the set off.
that's what I was, but you can input.
Yeah, there is an option, we can select and override the set off, but it is not, no, it is not working out. I have tried that.
That's why I'm saying, right? In all these cases, you will have to, if there is an assessment picked up, that try making a revised claim.
Sorry, CPC will be able to see first.
That's what I'm saying. Leave those cases. Out of the 10
Because assessment level, they already accepted the setup, so you can't do anything after that.
No, you can make a fresh claim, sir. Something you have missed out before the assessing officer, try making a fresh claim.
You will not accept
He will not
it.
accept. Start litigating the matter from there. Start litigating the matter from
There
there.
is a circular in 1955, which is also referred to in some of the judgments. Even after that, OH India Supreme Court and all, it is referred to in some of the judgments where that circular says that as an assessing officer, when you pick up the case for scrutiny, you are not just duty bound to say what he has done wrongly. You are duty bound to also see whether he has done everything correctly in the sense, is he eligible for some deduction which he didn't know. You should see that also. You should not just see whether, okay, he has claimed 6A, is it correct? He has claimed the expenditure, is it correct? So you should not look at it from the lens of denying something. You should also see whether he is eligible for something, he is not aware of it, and therefore.
What I'm saying is, in all those cases when you make a fresh claim, definitely 100%, 200% will be rejected. What I'm saying is that will sprout the seed for litigation for you. Start litigating the matter from there. So the matter reaches tribunal. They will say fresh claim can be entertained. And then they will start entertaining, seeing whether this okay cost. Because all these litigations, how did it pan out? Till tribunal, the seats would not have any relief. Only at the tribunal or the high court stage, they would have tried to see some relief. When you do such way, where you make a fresh claim before assessment, you are not having any exposure. Because whatever tax due which is otherwise required to be paid, you have paid. In the assessment, apart from other things, you are planning to litigate this matter. Do this also.
Can I give some free unsolicited advice?
Yes.
Practice what he has done. Always tell the client upfront what you are going to do, why you are going to do it. And if the client, I don't think would agree to this particular kind of
Litigation, everything.
No, in other words, don't get into a case. If litigation happens, then we'll get the benefit of it. But don't put me in its spot. And what
Yes,
my advice to my colleagues is always that tell the client upfront what we are going to do, what we are going to do.
Do so.
So this kind of.
In fact, client should be prepared. If he says, no, I don't want to litigate.
No, practically speaking, if you are the client, would you agree for such a kind of suggestion?
There are some clients who are willing to do.
I doubt, sir. Generally, they want to go and this is
Depends on the quantum. Depends on the quantum and the stage. See, also for the size of the unit.
quantum here is setting up the losses, so everyone will be happy. When there's loss on accounting year, on assessment year, and you don't settle the loss, then the problem comes. Then there's no quantum involved here.
No, suppose an assessee knows that this loss entirely he can set up in the next year. It's not going to result in a scenario where the loss is going to lapse.
But that's not an assured thing. It's a dicey, I have invest.
No, that's what I think. Not see.
So we tell the client that it's dicey investor. Right. And then I don't know.
If the client is okay,
Because it is a indefinite
question. But the
business loss is limited to 8 years.
listen, all these issues are something very prone to litigation, which as conservative persons, if the advice you would want to take, to be frank, I agree.
Somebody starts doing it and some court says this is right also, then we will be inventing an amendment like explanation 5 or
Definitely, 100% sure.
The salary people were setting up depreciation against salary. Basically, it was to save taxes. They saw that they said you cannot do this. You can set up against equity, not salary.
The moment you do this kind of tax planning, either they will say, I will make a specific anti-avoidance provision or change the law. What I'm saying is,
No, if your client is conservative,
You can't do
that means his risk appetite is not that much. Then you take the safer side. You take the side which normally the department accepts. I mean, this is it's my experience.
Correct.
That's what I learned in the
100% true. 100%.
So that depends on the risk appetite of the client. And it doesn't operate. And the conservative don't tell them all these things.
True. 100%.
In most cases, the auditors won't even tell this. They'll take the conservative one because they want to get into trouble.
No, because see, the problem is with the client, not with the auditor.
Yes. In some cases, as client feels such solutions, the auditors, some auditors, they will always take the conservative approach.
Yes, but
all of us here want to get into any kind of
So just one point which we want to cover, I think all of us would have practically seen this scenario. I think it's almost close to it. This form 3067, when it is not filed within time, when it is not filed online but during the course of assessment proceedings you file. I think there are a lot of cases, in fact.
The board also relaxed the limits of the time limit for some years.
Yes, earlier it was you should file on or before the due date of filing return of income. Now you have to file before the end of the assessment year. That relaxation came, I think, very recently, about a year back.
Last year also, board issued circular with controlling this kind of cases. So last year.
For Form 67, I don't think.
But there are case laws on this point.
Many cases are court.
Recall this particular thing. Just like for corporate trust, they said the board issued circular permitting the CAT exemptions to control the delay in filing Form 10, 9C, and 9A and 10B. Like that, I remember I read, but I can't offhand tell the entire citation, I remember, but it was there.
But he was that also. There are jurisprudence, uniformly.
No, I said filing of, filing time limits for filing of forms is always considered as act of directory, not a mandatory requirement.
Generally, yes. But after that, before Supreme Court, it was put a matter was
that decision was distinguished.
Yes.
It has been distinguished several other cases.
Yes, subsequently it has been distinguished, but when it came, it raised a lot of concerns as to if filing of form is such a sacrosanct thing, then any and every exemption or any and every
No, I think there is a fine distinction there. See, this 10A would have impact the competition of income. Whereas this filing of forms is procedural in nature. There is always some laxity shown in the case of procedural things rather than the competition things. Maybe I'm not.
In fact, Form 67, this has been the case with the residents also. Judicially, uniformly, all tribunals have held that this is not a mandatory thing. As long as you have filed it before the assessing officer, before the proceedings are concluded, this is fine. Credit cannot be denied merely because the form is not filed, because credit eligibility is not stemming from the form. It is stemming from the act led together with the DTA. This form cannot deny something which the DTA is enacting.
And the last thing which we want to conclude with is on the equalization levy. It started in 2016 for certain specified advertisement and related services, 6%, and in 2020 it got expanded to all online and digital services. And now since India is going to be part of the BEPS initiative, and then they are planning to, every country is going to planning to come with a unified approach for tackling this digital economy, the tax issues concerning that, they have decided to remove the second year, which is on other digital services, on specified services like advertisement, etc. Equalization levy still continues, but this is something more academic in the sense that as and when it comes and then people come into, like there are many companies who are coming into the radar, then we can concentrate. Academically, the second year is abolished. There are other examples which we thought we can also discuss, but possibly of time we will just share the slides also.
Yes.
You can have a look at it.
And mostly those are things which we have
Already
conceptually we have covered. So whatever we covered conceptually, we also put it on case level.
Yeah. So it was definitely a learning session for us as well, to be frank, because we got this opportunity to dwell deep more on this FTC and then learn more. So, but for these sessions, the opportunity for us would have also been limited, and we got a different perspectives from you also on this carry forward set of clauses, to be frank enough, and then it was also a learning experience for us. Thanks a lot.
Thank you so much.
Thank you so
This is
much.
I think the last 6 months is our third session, and every time we have gone back home with a new set of learnings from participants. So it is, and we are very humble because like we are speaking before senior practitioners. So that itself is a humbling experience for us, and thank you so much for this opportunity, and we'll be happy to continue interacting in future.
So a big thank you from all of us as well to make it a lot more eye openers and giving a lot of food for thought. Right? Trying out some new aspects. That's an interesting one. Whether to claim or just the correct.
Your email ID is.
Sorry.